Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be explaining to you the meaning of financial instrument, financial asset, and financial liability. Now, let's get to the details. Now, a financial instrument defined in IAS 32, and IAS 32 is financial instruments. Presentation. Now, this standard set out the definition of financial instrument, what a financial asset is, what a financial liability is, and the classifications of financial instrument. So, to start with the definition of financial instrument, it says that a financial instrument is a contract that gives rise to both a financial asset of one entity and a financial liability or equity instrument of another. So you will notice that two main things are involved in the definition. The first part is that a financial instrument represents a contract between two parties or two or more parties. Now, the other point is that we have financial asset, financial liability, or equity instrument. Now, let me give you an example to break down these definitions. Let's say entity A purchased loan notes in entity B. Now, the acquisition of these loan notes in entity B represents a contract between entity A and entity B. What it therefore means is that for entity A, there is a financial asset acquired. Now, for entity B, there is a financial liability. Now, the significant thing about the financial liability is that entity B, having issued these loan notes, would have an obligation to pay back the value of this loan note to entity A. Therefore, in the books of entity B, there is an obligation, and that makes it a liability. Now, entity A have a right to receive proceeds from this loan note, and that represents an asset. So, in this example, we have a contract which gives rise to an asset in the books of one party, which is entity A, and a liability in the books of the other party, which is entity B. Now, let me give you another example, still to build on this point. Entity A purchased ordinary shares in entity C. Again, entity A have made an investment. So entity A have made an investment which is a financial asset, and the description will be equity investment. They have made an equity investment. Now, for entity C, they have issued an equity instrument. Entity C have issued an equity instrument. So here you notice that there is a contract between entity A and entity C. However, it is not liability. It is equity instrument because there is no obligation on the part of entity C to pay back the investment in the ordinary shares. That is why we say it is equity instrument, not a liability. Now for entity A, it is an investment in equity what instrument. So it's a financial asset. It's a financial asset. Now let's move on to look at the details of what a financial asset is and what a financial liability is. Now, as per the standard IAS 32, a financial asset is cash, and we say cash is the most liquid. Is the most liquid of all financial assets. So cash is a financial asset because it gives you a right to acquire other assets, or it's entitlement of purchasing right. So it is negotiable. Now, a financial asset is also an equity instrument of another entity. So here, from the definition of financial instrument, we are looking at the entity C issued ordinary shares. So the ordinary shares is an equity instrument. So for entity A, it's an asset. Or we have share options, or share warrant. Share options can be a means of paying compensation to employees. So we call it share-based payments. Or there is a contract which the entity has a right to receive cash or another financial asset from another entity. So for example, trade receivable. So if the entity A is having an account receivable from customers, that account receivable represents a financial asset for entity A. And entity A can trade with these financial assets. Entity A can sell it to maybe a discounting or a factoring company to receive proceeds. Entity A is entitled to receive proceeds from these assets. So the last part of the financial asset is a derivative instrument standing at gains. Now, what does it mean to say a derivative instrument standing at a gain? Let me give you a quick example. Let's say entity A holds 10,000 shares in C. Entity A wants to sell these shares in 4 months. Now, entity A is worried that the price of these shares would go down significantly in 4 months. Therefore, entity A is likely to lose. So what entity A will do is to buy a hedging instrument. Entity A will buy a hedging instrument. From a financial market. And this hedging instrument is a derivative. So entity A buying this instrument, whenever the price of this instrument increases, entity A makes gains. So that derivative instrument entity A is holding, if the price of the shares goes up, and if the price of the derivative also goes up, subsequently, entity A will make a gain. So this contract represents a gain for entity A. Now, alternatively, entity A enters into a contract with entity D to purchase, let's say 10,000 barrels of crude oil at agreed price of, let's say, $100 per barrel. Now, please pay attention to this illustration to help you understand what this contract is. Now, entity A enters into this contract to buy 10,000 barrels of crude oil from entity D. Now, this can be agreed to be executed in 4 months' time. So it's in the future. Now, if at year end the price of the crude oil is 110. Now, let me make the point that this contract entity A and D have entered into is called a derivative. It's a derivative contract. Now, please pay attention. So, if at the end of the year the price of crude oil is 110, it means that entity A have already entered into a contract to buy at 100. So entity A will make a gain on that contract of 10. And this gain represents a financial asset for entity A. It represents a financial asset for entity A. Now, let's look at financial liability. The IAS 32 says that a financial liability is a contractual obligation to deliver cash or another financial asset to another entity. For example, trade payables. So where we have an accounts payable is a financial liability, or a debenture loan. So loan notes, like I've illustrated to you earlier, where entity C issued loan notes, that is a liability because there is an obligation. Or we have redeemable preferences. So preferences which are redeemable, they represent liability, even though they are shares, because there is an obligation to pay back to the holders. Now, or a derivative instrument standing at a loss. Now, let me go back to this example I've given you here, where entity A and D have a contract. So, if, please take note, if at year end the price of the oil is, let's say, 95 per barrel, entity A will make a loss. So there's a loss of $5 because entity A have an agreement to buy at 100. So, and that agreement represents a present obligation, and entity A must settle this contract. So therefore, by that year end, entity A will have a financial liability of the loss of 5 to recognize. So the loss of 5 times the number of barrels to be purchased will represent the financial liability to be recognized. Again, this is a derivative. I hope this helps you in your preparation, and also particularly how we deal with financial instrument, financial asset, financial liability. Please subscribe to this channel to receive updates on new videos.